Imagine waking up in a world where the most advanced financial innovations are no longer the exclusive playground of Silicon Valley elites or crypto-native technophiles, but are instantly accessible to anyone with a brokerage account, no matter where you live or how much technical know-how you have. Gone are the days of wrestling with intimidating seed phrases, the constant anxiety of losing your crypto wallet, or the ever-present fear that a single hack could wipe out your digital fortune overnight. Instead, with just a few clicks, you can tap directly into the wild, unpredictable, and potentially lucrative universe of crypto staking without ever actually holding a single token in your own custody. This is not a scene from a futuristic movie. This is happening right now. This week, the financial world watched history unfold as a new product debuted that could permanently alter the landscape of investing, ushering Main Street and Wall Street into a new era of digital assets and raising questions and concerns that even industry veterans are still struggling to fully comprehend. On a landmark Wednesday morning, the first ever Solana staking exchange-traded fund, officially named SSK, made its debut on the CBOE BZX exchange. This was not a minor blip on the market's radar. Within the opening hours, investors poured in more than $12 million in fresh money, and by the close of trading, the fund had clocked a staggering $33 million in volume. Let that sink in. Tens of millions of dollars exchanged hands in just a single business day, all centered around a blockchain project that, only a few years back, was dismissed by many as an obscure experiment. The Rex Osprey Solana staking ETF didn't just make headlines, it sent shockwaves across the investment world. For the first time in the United States, traditional investors could gain not only exposure to the price of Solana, but also a direct share in the staking rewards, something previously reserved only for crypto insiders and technical power users. But why is this moment so revolutionary? To understand that, let's travel back a bit. Solana is not just another digital coin buried somewhere in the endless scroll of trading apps. Launched in the year 2017 by Anatoly Yakovenko, a former engineer at Qualcomm and Dropbox, Solana set out with a mission: to achieve unprecedented speed and scale for blockchain applications. Its architecture is unique, blending proof of stake, where validators earn rewards by securing the network, with proof of history, a novel mechanism that timestamps transactions for near-instant confirmation. The result? A blockchain network capable of handling tens of thousands of transactions per second, all at costs so tiny they are almost invisible. This winning combination has turned Solana into a magnet for developers, entrepreneurs, and investors alike, each seeking the next big thing in decentralized finance, gaming, and even enterprise infrastructure. Over the past several years, Solana's ecosystem has exploded in both size and ambition. Major decentralized finance protocols, non-fungible token marketplaces, and even real-world asset tokenization platforms have all found a home on Solana. The numbers are jaw-dropping. By January of 2025, Solana's real economic value soared past $551 million in monthly transaction volume. Venture capital has flowed in at an accelerating pace. High-profile partnerships, hackathons attracting global talent, and a relentless drive for innovation have set Solana apart from many of its rivals. Of course, it hasn't all been smooth sailing. Solana has faced a gauntlet of challenges. Several high-profile network outages shook investor confidence, security concerns sparked heated debates, and critics questioned whether Solana could deliver on its grand promises. Yet the community responded with technical upgrades, improved validator incentives, and a culture of transparency and resilience that many other projects can only envy. For example, after a series of outages, the team implemented major code upgrades, overhauled network governance, and introduced robust incentives to attract more diverse validators, reducing the risk of centralization. Now, with the launch of the SSK ETF, the doors to Solana's ecosystem have swung open wider than ever before. Nathan McCauley, co-founder of Anchorage Digital, described it as a defining moment for digital assets and a significant step forward in full access to the crypto ecosystem. For traditional investors, the world of digital assets, once intimidating and complex, has been demystified. No more worrying about wallet passwords, node setup, or losing your keys. Instead, anyone can participate in Solana's growth and staking rewards through a familiar, regulated financial vehicle. But this breakthrough didn't come without serious hurdles. The Rex Osprey ETF had to navigate a regulatory maze worthy of a Hollywood thriller. The United States Securities and Exchange Commission, famous for its cautious, some would say skeptical, approach to crypto, raised red flags over whether the ETF truly qualified as an investment company under the strict rules of securities law. To overcome this, Rex Osprey engineered a clever workaround. The fund is structured under the Investment Company Act of 1940 and must invest at least 40% of its assets in other exchange-traded products, many of which are domiciled outside the United States. Nate Gerasi, president of Novadias Wealth Management, called it a regulatory end-around, a creative solution that allowed SSK to launch before a host of would-be competitors on the sidelines. The domino effects are already being felt. Bloomberg analysts now estimate a 95% probability that a spot Solana ETF will gain approval by the end of next year. This is not just idle speculation. Industry giants like Franklin Templeton, Bitwise, VanEck, and 21 Shares have all filed for their own spot Solana ETFs, setting off a gold rush among asset managers determined to stake their claim in this new financial frontier. James Seifert, a prominent Bloomberg analyst, predicted that the second half of 2025 could see a torrent of new ETFs, not just for Solana, but for other high-profile cryptocurrencies such as XRP and Litecoin. This could mark the beginning of what analysts are already calling altcoin ETF summer. However, as with every gold rush, opportunity and risk come hand in hand. The launch of the SSK ETF is a green light for innovation, but it is also a warning flare. Is this the dawn of an era where traditional and digital finance blend seamlessly, or the start of another speculative frenzy destined to end in tears? The answer depends on a tangled web of factors: network stability, regulatory clarity, the technical security of the Solana blockchain, and the willingness of institutional players to stick around through the inevitable storms. Solana's technical record is a study in contrasts. On the one hand, the network has now achieved more than 15 consecutive months of uninterrupted uptime, a milestone that few blockchains can boast. This level of resilience is the result of relentless engineering efforts, constant monitoring, and a vibrant validator community. But rewind the clock just a bit, and the picture is more complicated. In previous years, Solana was plagued by a series of high-profile outages, some lasting mere hours, others stretching into days. Each incident triggered panic, wild price swings, and a barrage of criticism. If the floodgates of institutional capital now open and the network buckles under the pressure, the fallout could be catastrophic. Billions of dollars could be lost in a matter of hours, sending shockwaves through exchanges, asset managers, and retail investors across the globe. Security is another ever-present concern. As more money flows into staking products, the incentives for hackers, malicious actors, and even rogue validators only increase. The attack surface grows larger, and the consequences of a single vulnerability, whether it's in the staking mechanism, the ETF's custodian, or the underlying blockchain, could be disastrous. Daniel Yan, co-founder of Matrixport, warns, if regulators tighten their grip or a major security flaw is exposed, you could see billions vanish in a matter of days. The stakes could hardly be higher, yet so are the potential rewards. On the upside, the opportunities for investors are nothing short of transformative. The SSK ETF's 7.3% staking yield towers over most traditional investments. For some perspective, the average yield on a standard savings account in the United States remains stubbornly below 1%, and even long-dated government bonds struggle to match what's now available through Solana staking. This yield differential has not gone unnoticed by institutional investors. In response to the ETF's debut, DeFi Development Corporation rolled out a private convertible note offering of $100 million, aimed squarely at ramping up its Solana holdings. This is a clear signal that the so-called smart money is not just spectating, they are deploying serious capital, betting that Solana's unique blend of speed, scale, and yield will outcompete rivals such as Ethereum, Cardano, and Avalanche. And the technical upgrades are coming thick and fast. Take the much-anticipated Alpenglow consensus code, for example. This upgrade aims to slash transaction finality times down to between 100 and 150 milliseconds, putting Solana in the same speed class as traditional payment titans like Visa and MasterCard. Just as importantly, Alpenglow will lower the validator capital requirements to $75,000. This democratizes network participation, making it feasible for smaller players to join the ranks of validators and help secure the network. The result? More decentralization, greater resilience, and a fertile ground for the next generation of blockchain innovation. Let's zoom out and consider what this all means for the broader financial world. If the SSK ETF is successful, it could set off a cascade of similar products, making exposure to dozens of blockchain projects as easy as buying shares in a tech ETF or a blue-chip index fund. Retirement portfolios, pension plans, and charitable endowments could soon include allocations to Solana, XRP, or even up-and-coming projects like Aptos and Sui. Recent research shows that Solana's CME futures saw unprecedented demand after the ETF's launch, with open interest reaching $167 million, a crystal-clear signal that institutional adoption is accelerating at breakneck speed. Yet, no discussion of innovation is complete without an honest reckoning with risk. Regulatory winds can shift in an instant. The United States Securities and Exchange Commission, which has a reputation for unpredictability when it comes to crypto, has shown it is willing to intervene, even after products have launched. The recent agreement to drop its case against Coinbase, in principle, is a positive sign, but it is far from a blanket guarantee of smooth sailing. Around the globe, regulators are watching with keen interest. If the United States paves the way, Europe, Asia, and other powerhouse economies may either open the floodgates or erect new barriers. Investors must be ready for abrupt shifts in policy, changes to tax treatment, or even outright bans in certain regions. Market volatility is another elephant in the room. Crypto markets are famous for their wild price swings. Solana's price, for instance, rose by 3.6% in the 24 hours following the ETF's debut, a solid move, though less than some had predicted. Over the previous week, Solana was up about 5%, yet it remains nearly half below its January peak. Analysts such as Arslan Butt from FX Leaders suggest that, if current trends hold, Solana's price could reach $200 in the near term, with further potential to climb to $300 or even $500 if momentum continues. But as history has shown, think back to the parabolic rises and crashes of Bitcoin, Ethereum, or the infamous .com bubble. Meteoric gains are often followed by sharp corrections. The ETF wrapper does not shield investors from the fundamental volatility of the underlying asset. For individual investors, these developments are both an invitation and a test. The line between traditional and digital asset investing is blurring faster than ever before. If you're considering jumping in, do your homework. Understand not just the dazzling potential rewards, but also the unique risks, liquidity constraints, lockup periods for staking, validator slashing penalties, and the ever-present specter of regulatory clampdowns. Ask yourself, are you prepared for potential network disruptions? Can you handle the emotional roller coaster of investing in technologies that are still evolving and maturing? Diversification is your friend. Never invest more than you can afford to lose, and resist the urge to chase the latest shiny object without a solid plan. Remember, while the ETF format simplifies access, it does not magically erase risk. For those already active in the crypto world, pay close attention to how institutional flows might impact liquidity, pricing, and overall market sentiment. Sometimes the crowd moves faster than fundamentals warrant, and herd behavior can amplify both gains and losses. If you're still watching from the sidelines, consider this your front row seat to financial history. The launch of the SSK ETF is not just a Solana story, it's a sign of how rapidly financial innovation can reshape the investment landscape. In less than 10 years, crypto has evolved from a niche experiment into a pillar of global finance, drawing in some of the most influential institutions on the planet. But let's not forget the lessons of history. Financial innovation always brings both new opportunities and unforeseen risks. The same mechanisms that make these products accessible can also turn minor missteps into catastrophic losses. The collapse of mortgage-backed securities in 2008, or the bursting of the .com bubble in the late 1990s, are stark reminders. As investment vehicles grow ever more complex and widely adopted, vigilance and education become even more vital. Behind the headlines about ETF inflows and Solana's price swings, the real game changer may be the relentless advancement of technology. The Alpenglow consensus code, for instance, is not just a technical curiosity. It could position Solana as the fastest, most efficient blockchain for real-world payments, enterprise software, and decentralized finance applications. By lowering validator capital requirements, it could ignite a new era of innovation, making the network more resilient and inclusive than ever. To wrap up, the launch of the very first Solana staking ETF is a watershed moment in the ongoing evolution of digital assets and global finance. It represents both a bold leap forward and a powerful reminder that risk and reward are inseparable companions in the world of innovation. The choices you make now, as an investor, a skeptic, or an active participant, will help shape the future of finance for years, if not decades, to come. Now we turn it over to you. Do you believe Solana staking ETFs will revolutionize crypto investing for the better? Or do you see the seeds of the next speculative frenzy? Are you ready to take advantage of the opportunities? Or will you watch as the next chapter of financial history is written? Share your thoughts in the comments below. Subscribe for more in-depth explorations at the intersection of technology and global economics, and ring that notification bell so you never miss a moment. Until next time, remember, every wave of innovation